The next time you're in the hardware store and you grab a drill, just know that you're not just buying a tool. You're picking a side in a really high-stakes corporate war. Today, we are diving deep into the massive battle for the power tool industry, a fight that is literally reshaping the aisles of your local store, and yeah, it's hitting your wallet too. Seriously, just think about that collection of power tools in your garage or packed in your truck. It is so much more than just a set of tools. It's basically a declaration of allegiance in this multi-billion-dollar war. On one side, you've got the old guard, the legacy giant, Stanley Black & Decker. You know them as SBK. They're the parent company of brands like DeWalt and Craftsman. And on the other side, the super aggressive challenger, Tektronix Industries, or TTI, the powerhouse behind Milwaukee and Ryobi. In the absolute heart of this entire conflict, it all boils down to one simple but incredibly powerful idea: battery ecosystem lock-in. See, in this cordless era, the battery, well, it's the new oil. Once you commit to a brand's 18 or 20-volt platform, the cost and the sheer hassle of trying to switch brands is just enormous. You are, for all intents and purposes, locked in. And that is why this war for your loyalty is fought tool by tool, battery by battery. It's everything to these companies' futures. So, to figure out who's really winning this thing, we're going to break it down across 4 key battlefronts. First up, we'll look at the retail kingmakers, the ones who decide what you even get to see on the shelves. Then, we're diving into the geopolitical tariff storm that's changing where your tools are even made. After that, we'll explore the fight for both the pro and the weekend warrior. And finally, we're going to check the scorecard, the financials, to see who really has the upper hand heading into 2026. All right, our first battlefront, the retail aisle. I mean, victory in this war is often decided before you even set foot in the store. It is a brutal, fierce battle for shelf space, and the gatekeepers, they're the big box stores. And check this out. This is TTI's playbook. In 2025, a staggering 45.4% of its entire global revenue, we're talking nearly $7 billion, came from one single customer, the Home Depot. This isn't just a place they sell stuff. It is a deep, strategic alliance. And here is where you really see the two different game plans. TTI, they basically put all their eggs in the Home Depot basket. And what did that get them? It gave their brands, Milwaukee and Ryobi, almost complete and total dominance in those aisles. Stanley Black & Decker, on the other hand, they spread their bets, relying on both Home Depot and Lowe's. But here's the catch with that strategy. SWK admits it themselves. When you have two gigantic customers like that, it gives them all the bargaining power, making it way harder for SWK to negotiate. Okay, so from the retail aisle, let's zoom out, way out to the global stage. Geopolitical tensions, especially between the US and China, have thrown a massive wrench into how everything is made, forcing both of these companies to adapt and fast or risk getting left in the dust. This timeline really tells the story of what we're calling the Great Manufacturing Migration. So back in 2018, everything was pretty much centered in China. Then, bam, US tariffs hit all those China-made goods, and both companies had to scramble. TTI was incredibly nimble here, quickly shifting and scaling up these advanced factories in Vietnam and Mexico to get around the worst of it. SWK also made a big push to move production to Mexico, but then, and you can't make this stuff up, in a classic case of shifting political winds, those Mexican-made tools got hit with new tariffs. But for Stanley Black & Decker, the problem actually goes a lot deeper than that. Right there in their own annual report, they call out a huge vulnerability. They rely on rare earth minerals from China for their electric motors. And get this, they even said that Chinese export restrictions in April of 2025 already caused them delivery delays. That is a massive risk that TTI, with its more diversified global hubs, simply does not mention in its reports. Okay, so we've covered the stores, we've covered the globe. Now let's talk about the people actually buying the tools. We're talking about the fight for both the professional contractor on the job site and the do-it-yourself weekend warrior. TDI's ace in the hole here is Milwaukee. This brand aims squarely at the pros, is an absolute growth engine. I mean, it posted a 10.3% organic growth rate in 2025. And this isn't just about selling more tools. It's about selling high-margin, premium tools, which is just a massive boost to TTI's bottom line. Meanwhile, Stanley Black & Decker is really feeling the pressure on the other end of the market. And these are their own words, not mine. They say they face active competitive threats from the low-cost house brands that their own retail partners are pushing, the store brands. And that puts a ton of pressure on their iconic DIY brand Craftsman. And in that DIY space, TTI has another incredible advantage, a real secret weapon, with Ryobi. Its 18-volt ONE+ battery system, it's backward compatible with every single 18-volt Ryobi tool they have made since 1996. Just think about that for a second. That is an unbelievable competitive moat. If you bought a Ryobi drill back in the 90s, you are still part of today's ecosystem. Talk about that powerful lock-in effect we mentioned earlier. So, we've looked at the retail channels, the supply chains, the brands. I think it's time to check the scorecard. Let's see how all these different strategies actually translate into the hard financial numbers.
If there is a single slide that tells the whole story, it's this one. The gross margin gap. In 2025, for every dollar of tools TTI sold, they got to keep 41.2 cents after paying for what it cost to make them. For Stanley Black & Decker, that number was just 30.3 cents. That is a massive, massive 1,090 basis point difference. It's not just a gap, it's a chasm. It just goes to show that TTI's strategy, focusing on pros, agile manufacturing, and a strong retail partner, is paying off in a huge way.
And all that profitability is backed up by some incredible operational speed. Just look at the cash conversion cycle. That's basically how fast a company can turn its inventory into cold, hard cash. TTI does it in just 56 days. It takes SWK around 91 days. And a big reason why is SWK's huge inventory problem. They are sitting on over $4 billion in inventory, which is over 27% of their annual sales. That's cash that's just tied up in a warehouse instead of being put to work. So let's just put it all together here. This matrix gives us that final clear snapshot. TTI is defined by that laser-focused pro brand in Milwaukee, that super concentrated partnership with Home Depot, and their really agile global manufacturing. SWK is trying to counter with its legacy brands, DeWalt and Craftsman, a much broader but more pressured retail strategy, and this massive ongoing effort to untangle a really complex global supply chain. So what's next? Well, Stanley Black & Decker is right in the middle of a massive turnaround. They're trying to shed over $2 billion in inventory and just simplify everything they do. TTI, on the other hand, is hitting the accelerator, doubling down on the speed and the premium products that got them this far. So the real question isn't just who's going to win the next quarter, but who is building a foundation that's strong enough to really dominate the next decade of power tools. All the data we used for this breakdown was pulled from 2025 corporate disclosures. So if you want to take a deeper dive into the full reports, you can visit the source over at hdnresearch.com. And of course, just a friendly reminder that this analysis is for informational purposes only. It is not investment advice. Thanks for tuning in.